Okay, so let's go ahead and take a look at this now. This is the chapter 4B quiz now. Okay, and let's take a look at this first question, which, yeah, we have the same question twice. Number 1 and 2 are exactly the same. We won't have to do it twice. We'll just do it once. Okay, so the City of Kent Police Department needs a new police car. A police car is ordered at an estimated cost of $34,000, and the appropriate budgetary control entry is made. Now, this question didn't ask this in order to answer this question, but when we order it, we would have debited encumbrances, credited budgetary control for this $34,000, right? Okay. Then they say the actual cost is $35,000. And which of the following is part of the budgetary entry that should be made when the police car is received? Okay. Well, when it is received, we're going to do what? We're going to go ahead, good, and reverse for that original amount. You can see right here by debiting the budgetary control and crediting the encumbrance. That's why I labeled that number 2. That's what we do when the stuff comes in, and then we debit expenditure and credit vouchers payable for the actual amount, right? Okay, so is it true that when the car is received, we would credit encumbrance? Is that true? Okay, which is the answer to this question. Okay, now when you get questions like this, guys, and I'm sure you've seen this in your other classes, in counting classes, where they give you a chunk of the journal entry, that is intentionally trying to mess you up so that you're sitting there in your head trying to figure out in your mind what this whole thing should look like. Your best way to answer this is the long way, which is to make all the journal entries associated with the whole thing, and then the correct answer looks very obvious to you, right? Okay. Question? Okay, good. Yeah, number 1 and 2 were exactly the same. No, number 1 is when you order it. Number 2 and 3 are what you do when you receive it. We haven't paid for it yet. It's in vouchers payable, right? When we actually pay that vouchers payable, then, of course, we will do what? Debit, huh?
Debit vouchers payable, credit cash.
Good. Debit vouchers payable for 35,000? And credit the cash when you actually pay it. That debit to expenditure, credit to vouchers payable, what I've labeled number 3 up there, is what happens when the goods are received, right? And it's a police car, so we debit expenditure at the fund level, right? Because it's a long-term item. Okay? Okay, good. Which of the following is not a character classification? Now, I really could have asked you this from the chapter 2, okay, but you should know this for your midterm. Character classification does what? Tells us the period of benefit, and we have what? We have current as a period of benefit. We could call it what? Equipment, which means it's going to benefit both the current and future period. We could call it what? We could call it debt service, which means it should benefit the current and future period. We could also have what? An object class. Object class is like a chart of accounts that tells you whether it supplies, etc., right? Okay. So when you look at all these, current, yeah. Capital outlay, yeah. Debt service are all what? Examples of character where it's going to talk about the period of benefit. Okay, whereas what? Activity, not only is it not a character designation, we don't put any kind of level on our label on our expenses that talk about specific activity, right? Maybe program is about as close to activity as we get. Okay, and that was back in chapter 2, I think. Okay? Okay, good. Governmental unit uses encumbrance accounting. During the year, the government ordered but had not yet received a new police car. What effect will these events have on the unassigned fund balance in the appropriations ledger? Okay, now, when we talk about our appropriations ledger, remember we have our appropriation. Say our appropriation was 100,000. Okay, and then what? And then we sit here and we ordered goods of 45,000, so our available appropriation would go down to 55,000. I'm just making this up. Okay, so the available unassigned appropriation at that point in time would be what? 55,000, but it's going to have an effect of decreasing my what? My unassigned available appropriation at that point in time because I've ordered some goods. Right? Okay. Another way to look at this same question would have been to sit here and say, well, look, if I ordered some goods, let's say I ordered the goods for 45,000 in this example. You're saying where you're getting these numbers, I'm just making them up. I debited encumbrance 45,000. I would have credited bud control, right? For 45,000. Okay. Thus my available appropriation comes down. My unassigned appropriation, that I can spend on whatever comes down, doesn't it? Okay. Then what happens? Then during the year the government ordered but not received a police car, what effects will this have on the unassigned balances? We see it took it down, but let's just look at the unassigned fund balance that we would report on the balance sheet at that point in time, right? So let's say we had cash of 100,000, and let's say it was all unassigned. 100,000. So we've got what? We've got cash of 100,000. We've got an unassigned fund balance of 100,000, right? Okay. Then we make this entry during the year. The goods still haven't come in by the end of the year. Goods still haven't come in by the end of the year. Okay. And so if the goods still haven't come in by the end of the year now, what do I have to do with this entry at year end? Good. I'm going to reverse it by debiting bud control for 45,000 and crediting the encumbrance, right? Does that reverse it? Does that close it? Then what do? I close the budgetary entry. Now what do? Huh? I'm going to what? Debit what? Good. I'm going to debit unassigned fund balance for 45,000 and credit assigned, just like I showed you in the comprehensive example a minute ago. Is that what I would do? So when I prepare my balance sheet, if my unassigned started with 100,000 and I just debited it with what? For 45,000? I just debited for 45,000? What's the balance in here now? Balance is 55,000. And so when I prepare my income statement, I still have the cash because I haven't paid for this stuff yet, right? I still have the cash. I have an unassigned fund balance now of 55,000, and I have an assigned fund balance of what? 45,000, don't I? The assigned fund balance is 45,000. Does the balance sheet balance? Does the balance sheet balance? Okay, so you could look at it a couple different ways. What's available in the appropriations ledger? 55,000. This is my appropriations ledger, right? Where I put that debit to the encumbrance in there, which reduces the available balance in the appropriations ledger. Or you could look at it as to how I report it on the balance sheet. I'm going to be reporting a what? A smaller unassigned fund balance than I did before I ordered that stuff, right? Okay. Question? Okay, good. Public school district budget estimated revenue of 800,000 and approved appropriations 780. Which if the following is the correct entry to record the budget at the beginning of the year? Debit the estimated revenue, credit the appropriation for the amount of the appropriation. We need a credit to make this journal entry balance. That credit goes to budgetary control, right? Number 6. A county general ledger includes budgeted revenues of $900 and budgeted expenditures of $890. Actual revenues for the year were $915. To close the estimated revenue account at the end of the year, well, again, at the beginning of the year, we would do what? Debit the estimated revenue, credit the appropriations, $890, credit budgetary control. Then what? What actually happens to the revenue, the actual revenues, is of no consequence as to what I do at the end of the year, which is reverse the beginning of the year entry by debiting the budgetary control for the 10, debiting the appropriations for $890, crediting the estimated revenue. The answer to this question? Number 7. Question? I mean, now's the time. I mean, you know, if you're sitting there saying, well, I'll figure it out the night before the exam, I suggest you rethink that. Question? Okay, good. Carolina City places an order for a specific item of equipment and encumbered $6,000 for the item. Is that the journal entry you make when you order? Debit encumbrance, credit the budgetary control? Okay. The equipment arrives at an invoice price of $5,700. Which of the following entries would the city make upon receipt of the equipment? Well, upon receipt, I will debit budgetary control, credit encumbrance for the estimated amount that I originally had stuck in there, and then I debit expenditure, credit vouchers, payable, cash, whatever, for the actual amount, don't I? So is it true that I debited expenditure for $5,700, debit budgetary control for $6,000, credit the accounts payable, vouchers payable, accounts payable for $5,700, and credit encumbrance for $6,000? So kind of a weird way they presented that entry, but if you write the whole thing down the way we've studied it, then you can kind of work your way through to figure out what the right combination of debits and credits are to answer this, right? Okay. Question? Okay, good. Let's take a look at number 8. A city we will come back to this. We are going to talk about inventory tonight. Okay, I wanted to go ahead and jump into the quiz first. We're going to talk about how to account for inventory under the consumption and under the purchase methods, the two methods that we'll talk about here. So hang tight for that. We'll come back and look at these questions. Okay. Same thing with number 9. Number 10, in a statement of revenues, expenditures, and change in fund balance, a transfer received by the debt service fund from the general fund should be recorded by the debt service fund as a transfer in when that money comes in. Transfer in is one of my 2 other financing sources. What are my 2 other financing sources? Transfer in and, transfer in and what? 2 other financing sources. Transfer in and, 2 other financing sources. Transfer out is not another financing source. Transfer out is another financing use. There's only one other financing use, transfer out. What's the 2 other financing sources? Okay, long-term debt proceeds and what? Transfer in, right? Okay. Hello? Okay, good. Number 11, data. And you can see the journal entries up here. The general fund, if it was $10,000, would have debited other financing uses, transfer out, credited cash. At the same time, the debt service fund debits cash and credits other financing sources, transfer in, right? Okay. Okay, good. This question, you won't get one like this on the exam. because this is sort of a free response type question. Okay, I'm going to give you multiple choice, but it's still a nice thing for us to work through because it's sort of comprehensive and goes through the whole process with us here. Okay, so let's take a look at this. They give us these different amounts, and they want us to go ahead and give the journal entries that would have generated that correspond to the information that they're giving us here. Okay, so you come over, and what happens? We have estimated revenue of 13.8. We have what? We have estimated. We have our estimated revenue of 13.8. We have our what? Appropriations down here of 13,000. Okay, and so the excess of estimated revenue over appropriation is 800. Can you make the beginning of the year journal entry from that? Okay, so the beginning of the year entry would have been to do what? To debit the estimated revenue 13.8, credit the appropriation 13, and credit the budgetary control 8. Okay, so the way you would have worked this problem is you would have seen this and said, okay, I can figure out the journal entry that goes with that, right? Okay, then what happens? Then they sit here and they give us these amounts encumbered. They give us our estimated costs. They give us the actual cost, and then they give us the revenue information, right? So now we can go ahead and make the journal entry for the revenue. And they tell me that what? They think that they are going to collect 1%, that they're going to collect revenues of which 1%, how do I want to say this? They're going to have revenues of which 1% are going to be uncollectible. So remember, we do what? We set up the taxes receivable gross, don't we? Okay, so the taxes, 99% of tax receivable is going to equal the 13,000 we think we're going to collect. So the gross amount is going to be 13,131, just doing the algebra on that. Okay, so for the amount of revenue, we do what? Just taking a look at that entry. Let's see where they put that. I'm going to do that one down here. We debit tax receivable 13,131, right, which was the 1% that was uncollectible. 1% means that we put 131 in the allowance and credit the revenue for the net, which they gave us that, right? Okay. Okay, good. Then what? Then let's go ahead and let's deal with these encumbrances. And they say the amounts encumbered were 12.4. Well, do we know what to do if we encumbered 12.4?
Credit encumbrances, debit budgetary control.
Okay, flip that around and we got it. Okay, so we do what? We debit the encumbrance and credit the budgetary control.
Yeah.
Right. You said the opposite, but yeah. Debit encumbrances, 12.4, credit budgetary control, right? Now, when we do, notice I have a 12,400 balance in my encumbrance account, obviously, right? Okay. Now, they tell us that what? They tell us that the amounts that we have ordered is what? Amounts, estimated cost was 12.4. And then they tell us that what? The actual cost was 10.9. Okay? So what's going to happen? We're going to sit here and we're going to, this is the amounts encumbered. Sorry, guys. This is the amounts encumbered was 12.4. The what? The amounts received and the estimated cost was 10.9. The actual cost was what? 11.2. Okay, so what will we do? We'll go ahead and we'll sit here and we'll reverse for the estimated cost, right? What we originally set it up for by debiting budgetary control 10.9, creating the encumbrance, debit expenditure, credit voucher payable for the actual amount, right? Okay. Now when we do that, there's still what? There's still 1,500 outstanding in the encumbrance account, isn't there? So that means that at the end of the year, we're going to have to do what? We're going to close that outstanding by debiting the budgetary control, creating the encumbrance. That closes that out. But then we have to set up what? We have to set up that unassigned fund balance, take it out of unassigned and set up the assigned fund balance for the amount that's still outstanding. Right? And then what? And then you do have to close your beginning of the year entry by debiting appropriations, creating the budgetary control, and you have to what? Close your actual accounts, and you close that to the unassigned fund balance, debit the revenue, credit the expenditures, just like any set of closing entries. Okay? So this was sort of a comprehensive example here that sort of leveraged off of the example that I gave you, the comprehensive example that I gave you. Okay. I won't give you one like this, but this is a good thing for you to study and understand because I could break these out into individual multiple choice questions, right? Question? Okay. So the process is what? Beginning of the year entry, debit the estimated revenue, credit the appropriation, assuming a surplus, credit budgetary control, right? We do that at the beginning of the year. During the year, what happens? We have our actual revenues that come in, okay? Then what? When we start to spend, so we debit our taxes receivable or our cash, credit the revenue, right? And if we have an amount that's uncollectible, we have to set up an allowance for that, right? Next thing is during the year, we order stuff. When we order stuff during the year, we will do what? Debit encumbrance, credit budgetary control. When the stuff comes in, we reverse the original encumbrance entry by debiting the budgetary control, crediting the encumbrance, debit expenditure, credit vouchers payable for the actual amount, right? If there are any outstanding encumbrances at the end of the year, what do? We have to close those encumbrances out by debiting the budgetary control, crediting the encumbrance for any outstanding. Set up the assigned fund balance by debiting the unassigned fund balance, crediting the assigned fund balance for any amounts that are still outstanding, right? Okay. Then what? Then we have to close our real accounts by debiting our expenditures, crediting our revenues, crediting fund balance, or debiting fund balance, I guess, if we had a deficit. And then what? Reversing our original beginning of the year budgetary entry. That's the process that we studied in the comprehensive example. That's the process that they went through right here, right? Question? Okay. Number 12, how should a city's general fund report the acquisition of a new police car? Expenditure, right? Yeah. We don't have equipment in our general funds, in our governmental funds. No equipment. Modified accrual accounting. When Spruce City receives goods at a cost at $9,700 that were encumbered in the prior year for $10,000, which of the following entries are required and assume encumbrance lapse at the end of the year? In other words, they're saying we close those at the end of the year. But when we finally receive them, we'll do what? We'll debit expenditure for the actual amount, credit budgetary control for debit budgetary control to close it for the what? Original amount we had set it up for. And then what? Then credit the accounts payable or vouchers payable and credit the encumbrance to close that, right? Now, the only thing that might have screwed you up is it says, but we ordered those in the prior year. But remember, when we went into the second year in the comprehensive example, we reestablished the encumbrance, didn't we? We put the encumbrance back, and then we did like we would have done if it had been received in the first year. Debiting the budgetary control, crediting the encumbrance for the original amount that was set up, debiting the expenditure, crediting the vouchers payable. So you do reestablish the encumbrance, right? And that next year? Okay. Number 14. The city of Denton uses encumbrance accounting for the control expenditures. It charges the cost of outstanding purchase commitments to expenditures in the year they are received, not in the year they are ordered. If the city had 11,000 of purchase commitments outstanding at the end of year 1 and received those in year 2 at a cost of 11,000, what would be the impact on total fund balance for year 2? Okay, now let's just go ahead and go through the whole process with this. So we have cash of 11,700. This is my balance sheet. I have unassigned fund balance of 11,700. With me so far? That's the very start when I order this stuff. I mean, when I start the year, before I order anything. Then I go ahead and I order the stuff. So I go ahead and I debit encumbrance. And I debit encumbrance. What did they say? I ordered stuff for 11,000. And credit budgetary control for 11,000. That happens in year 1. Okay. Then what? Year 1 comes to an end, doesn't it? So what should I do? What should I do when year 1 comes to an end? Huh? Okay, I'm going to go ahead and I'm going to reverse it. I'm going to debit bud control for, what is it, 11,000? And I'm going to credit my encumbrance for 11,000. Now what do you want me to do? Huh? What? I'm going to debit the unassigned fund balance for what? 11,000? And I'm going to credit what? The assigned fund balance for 11,000? Is that what I'm supposed to do? Okay. Now when I prepare my balance sheet now at the end of year 1, I'm showing cash of what? Has cash changed? Cash is still 11,700. And when I get to the fund balance, my unassigned is now how much? The unassigned is now 700, isn't it? And the what? Assigned is 11,000. Is the total fund balance the same? Is the total fund balance the same? Total fund balance is the same, isn't it? Okay. Now, what happens? This asks me what will happen to the total fund balance at the end of year 2 versus the end of year 1, right? Okay. So, when I get to year 2, the stuff comes in, and it comes in at an actual amount of what? 11,700, doesn't it? When I get to year 2? Okay. So in year 2, I'm going to go ahead now, and the first thing I'm going to do is debit the assigned fund balance for 11,000. Credit the unassigned fund balance for 11,000. And when I do, the unassigned comes back up to 11,700, doesn't it? Now the unassigned's back up to 11,700. It had 700. I just credited it for 11,000. Debited the unassigned. Unassigned is 0 now, and the assigned is 0 now, and the unassigned is back up to 11,700, isn't it? It's back up to 11,700. Okay, and then I'm going to go ahead and I'm going to debit encumbrance for 11,000 and credit budgetary control because I have to put that encumbrance back, don't I? For 11,000. So now I've set up the encumbrance again. Now the stuff comes in and it comes in at an invoice price of what? 11,700, doesn't it? Hello? Okay, so what am I going to do? I'm going to debit bud control for 11,000, credit encumbrance 11,000, which closes the encumbrance entry now, doesn't it? Doesn't that now close the encumbrance entry? And then I'm going to go ahead and I'm going to debit expenditure for, what's the actual cost? 11,700, and credit, we'll say cash, 11,700, because I got to pay for that now, don't I? Okay. Then what? Do I have to close my expenditure account at the end of the year?
Yeah.
Just like any set of closing entries? So at the end of the year, I'll debit the unassigned fund balance for 11,700, and I'll credit the expenditure, right? To close it for 11,700. So now the amount in the unassigned fund balance is what? 0, isn't it? It came back up to 11,700 when I put the 11,000 back. Now it's down because I closed it, didn't I? And the cash is 0. So now when I prepare my balance sheet, I've got cash of 0. I've got what? Fund balance of 0. Does the balance sheet balance? Does the balance sheet balance? Is it true that between year 1 and year 2, the total fund balance came down 11,700? At the end, huh? Well, why did I thought I heard no? The fund balance total, unassigned and assigned, was 11,700, wasn't it? Now the total fund balance is 0, isn't it? Okay? Question? Okay, so one time, I just assumed it at the very beginning of the year, at the very beginning of this problem. I assumed a balance sheet with cash of 11,700. The problem didn't say that, but I know I have unassigned fund balance of 11,700 though, right? So I had to have assets that would, if netted against liabilities anyway, would add up to 11,700, right? Question? I saw this thing on Rate My Professor one time. I used to look at Rate My Professor all the time. Now I don't. When I first discovered Rate My Professor, I kept looking at it all the time. Oh, what'd they say about me now? And, all of a sudden, I went from hot, and then my little red hot chili pepper went away. And I was like, I'm not hot anymore. It was starting to play with my self-worth was going away and stuff. So I stopped looking at it because I was getting obsessed with it. But one point in time I looked at it and somebody said, if you want an A in Lord's governmental class, you better really know what you're doing. No shit. Okay. So you need to know what you're doing for a question like this, right? Question? Okay, good. All right. You sure? Okay, good. Let's go ahead then and let's look at this one. Number 15 now. Washington County received goods that had been approved for the purchase, but which payment had not been made. Should the following amounts be increased? Should my expenditures be increased? They should. Washington County received, we received goods. Okay, we received the goods. We received the goods, so what should be increased? Expenditures are increased, right? How about encumbrances? No, encumbrances are what? decreased, we credit the encumbrance, debit the budgetary control, and the stuff comes in, right? Number 16. Which of the following cases would the reserve... Okay. It's no longer called reserve for encumbrances, and sometimes I have to fight to get all of these out because the books refuse to fix it. I've gone after these books and they won't fix it. It's not called reserve for encumbrances anymore. It's called budgetary control. The old, now discarded name for reserve for encumbrances is budgetary control, but textbooks hang on to that because that's the last thing they understood when they wrote their books, and they don't want to change it. I had an experience where I got them to change it in one of the books, and they said, "Oh, thank you for that. We're going to acknowledge you in the front of the book." And I said, "Oh, that'll be great, you know." And I showed my dad. I said, "Look, Dad, they acknowledged me in the front of the book." He's like, "Who's John Lord?" Me, Dad, I am John Lord. Huh? Who? What? What's for breakfast? Okay. So what happens? One time I played in one of my videos. I played him one of the video I put up on the smart TV. "Look, Dad." He goes, "Who is this idiot?" Okay, that's me. Okay. All right. So what happens? We sit here and we have our what? So they acknowledge me in the front of the book. So I adopted that book for one semester because, look, I'm in the front of the book. And then when I got to the back of the book, they hadn't fixed the back. They only fixed the first 3 chapters or so. And they say, you tricked me into using your book, okay? So they should fix it in all the books, but they don't. Okay, and sometimes I haven't rooted all these out. It is no longer called reserve for encumbrance. It's called budgetary control. Okay, and so what happens? Which of the following cases would the budgetary control account be decreased when goods related to the purchase order are received? We debit the budgetary control. That reduces it. Turns it back to 0 or whatever. Which of the following account does not affect the excess of revenue over expenditures? Okay, this is a question that is frequently missed on the exam when I give it to you because you forget about the questions that ask you about the structure of the financial reports. Remember, we talked about the structure of the statement of revenues, expenditures, and change in fund balance, in which we had what? Revenues minus expenditures yield us an item that we analogize to operating income, which we called excess of revenue over expenditures. Then we continued on and we had what? The sort of non-operating section in which we had the other financing sources and uses. Remember that whole discussion? Okay. So which of the following would not affect the excess of revenue over expenditures? How about purchase of capital asset? That's an expenditure, isn't it? So it would affect that. How about incurring and paying salaries? That's an expenditure, so it would affect that. How about property taxes levied and collected in the year? That's revenue, isn't it? Okay. How about transfers from the enterprise fund? That's going to be another financing source. That's going to be down in that non-operating section, right? It would not affect the excess of revenues over expenditures. So we've kind of slipped a little bit into what? Into midterm review mode here, because we really didn't talk about that in Chapter 4B. Okay? But for your midterm, you should absolutely have to know that. Which of the following would be classified as other financing sources, uses, transfer from the internal service fund, right? Yeah. What are the 2 transfers in? And transfers in. What is the one other financing use? Transfer out. Good. The following information. The change in Scott's general fund balance for the year would be what? The appropriations and the what? Estimated revenues do not affect the fund balance, do they? I debit estimated revenue, I credit appropriation, I credit budgetary control, assuming a surplus, right? At the end of the year, I reverse that all out and close it. It has absolutely no effect on fund balance. The one that affects fund balance is what? The real accounts, right? So at the end of the year, I would do what? I would debit my revenue. How much is my revenue? 14,800. I mean, 14 million. Sorry.
14,200,000.
Where is it? 14,200,000. Thank you. Good. I would credit my expenditures for how much?
14,800,000.
Good. 14,800,000. Okay. Good.
And then debit UFB for 600,000.
Good. Debit unassigned. Good. UFB. I like that. Unassigned FB. Unassigned fund balance. The UFB. Look, it's a UFB. Okay. That's going to be what, for what? For the 600? But it is going to do what? Decrease my fund balance, right? And then they came out and said, take me to your leader. The UFBs.
Aren't they unidentified flying bananas?
Unidentified flying bananas, okay. If you want it to be. Sounds like something that could happen to you in a bad neighborhood. Okay. When I was a kid, when I'd be getting ready to fall asleep at night, you know how when you first close your eyes at night and you can kind of see, like, you know, little squiggly lines and stuff as your eyes adjust to the darkness? Well, for some reason, I would get afraid of those, and I'd say, it's the number people. And my parents were like, huh? What's the matter? What number people? I'd say, the number people. I made up a name for that thing. Now I realize I wasn't losing my mind. I was just having a premonition of my future. The number people. Okay. Okay? All right, good. That's a good one to end on. Okay? All right, so why don't we do this? Yeah, I'd say we've earned a pretty good break right now. We'll come back. We'll talk about inventory, and then we'll go through the I'll come back to the inventory questions on this test, and then we'll go ahead and do the first practice midterm. Okay? All right, guys, so kind of a quick break, but let's go ahead and take a quick pause, and we'll come back. And start the recording. Since it's a current asset, inventory is a current asset, we're going to have to make sure that we report it on our financial statement, right? Okay, so we want to see how that's going to work. And remember, when we have inventory, we need to report that as a non-spendable fund balance. Yes, sir? Yeah, sure. Okay, so we have to report it as a non-spendable fund balance as well. Okay? So when you take a look, you can see that we have basically two methods to account for inventory. Okay, we have the purchase method, we have the consumption method. Now, GASB would prefer that companies, that governments, use the consumption method, but they allow the purchase method, and they say if it is not materially different from the consumption method, go ahead and use the purchase method. So we need to understand both. I'm always irritated when the accounting standards say if it's not materially different, go ahead and use the other method. But I would have to compare both methods to see if it's materially different or not, right? So it's kind of annoying. But let's just go ahead and let's take a look at both methods here. Let's start with purchase method. Okay, so we are going to assume that the city of Hayward, before we do anything, before we buy any inventory at all, that they have their balance sheet right here. Did you see on line 9 here? Which is cash of $100,000, no liabilities, unassigned fund balance. And it would be the same under both methods, right? That's before they purchase any inventory. Now, what happens? When they purchase the inventory, they will debit expenditure and credit cash for the full $100,000. Now, this is under the purchase method. We treat the entire purchase of the inventory as an expenditure, sort of the way we treat the purchase of fixed assets, right? In the governmental funds. Okay, this is the modified accrual. This is for our governmental funds. Then during the year, I tell you that they use $45,000 of inventory. Under the purchase method, there's no entry. We don't do anything. We don't do anything as we actually use up the inventory. Now, if you had 100,000 of inventory and you used 45,000, how much should you have left? 55,000. So we're going to have to bring that 55,000 onto the balance sheet, and we're going to have to set up a non-spendable fund balance for 55,000. Okay? So how are we going to do that? Well, first, let's look at the statement of revenues, expenditures, and changes in fund balance. And we'd have revenues. I'm assuming that was the only transaction. We just bought that inventory. Revenues of 0. Expenditures of 100,000, right? Because we debited expenditure up here. Expenditure of 100,000. And so the what? Change in fund balance is going to be a negative 100,000. Right? Then when I do my closing entries, I'll do what? I'll credit my expenditure to close that. I'll debit the unassigned fund balance to close that, right? So that when I prepare my, and then when I go, I have to bring on the 55,000 for the inventory that's left, right? I've got to show that. So I debit inventory 55,000 and I credit non-spendable fund balance 55,000. And when I do, now my balance sheet does what? It shows the inventory at 55,000. It shows the non-spendable at 55,000, right? No matter what happens, if they drop an atomic bomb, the governmental accountant's hand will reach out from the rubble and make sure that the amount that's shown as inventory matches the amount that's shown as non-spendable fund balance for inventory. Those two amounts must match. They have to match. Now, if you do a T-count analysis of fund balance, we started out with a credit balance of 100,000, didn't we? Didn't we start out with a credit balance of 100,000? Right here? Focus, guys. We start out with 100,000 here, right? You can't drift off here and expect that you got any kind of hope. We have what? We have fund balance of 100,000, didn't we? When we started. So when we started out, we had an unassigned fund balance of 100,000, didn't we? Then when we did our closing entries, we debited the unassigned fund balance for 100,000, right? When we did our closing entries, credit expenditure, debited the unassigned fund balance. When we did, that zeroed out the unassigned fund balance. There's no more left, right? And then didn't we just sit here and debit inventory for 55,000 and credit the non-spendable fund balance for 55,000? That's how we got here. Okay, so purchase method what? Purchase method, again, when you acquire the inventory, debit expenditure for the whole amount, credit cash, whatever, right? During the year, when you actually use some up, you don't make any entry. End of the year, you count to see what's left, right? You're going to have to count to see what's left, and you're going to see that you have 55,000 left, right? And so what do you have to do? You have to sit there and you have to set up the inventory by debiting the inventory for, where did I put it now? Where it's the end of year entry here. You have to debit the inventory for 55,000, credit the non-spendable fund balance for 55,000, and you make your closing entries by crediting expenditure, debiting the unassigned. And when you do, you saw our T account analysis, you end up here, don't you? Okay? Now that's the purchase method. Consumption method, and I'm going to show you this on, it's going to take us 2 tabs to fully understand the purchase consumption method. That was the purchase method. Consumption method is more like accrual accounting, in which you purchase the inventory, you debit inventory, you credit cash, right? Right? Yeah. Then, as I use the inventory, I debit expenditure for the amount I used, I credit inventory, right? Now when I do, and I sit there and I prepare my statement of revenues, expenditures, and change in fund balance, I'm going to have what? Revenues of 0, expenditure of 45, and my change in fund balance is going to be a negative 45, right? Right? Okay. Now let's just go ahead and let's look at the second tab and see how I'll make sure that my fund balance is showing up correctly. So when I purchase the inventory, I debit inventory, I credit cash, right? At that point in time, I will debit the unassigned fund balance and credit non-spendable fund balance, so the amount in the inventory account will match the actual inventory, right? So when I do that, Now I'm showing inventory of 100,000. I'm showing unassigned fund balance of 0, and I'm showing non-spendable fund balance of 100,000. Does the balance sheet balance? Does the balance sheet balance? Got inventory of 100,000. I got non-spendable fund balance of 100,000, right?
Yeah.
Then during the year, as I use the stuff up, I'll go ahead, I'll debit expenditure, I'll credit inventory. When I debit expenditure, I credit inventory. The amount in the inventory account shows 55,000 now, doesn't it? Which is what it should show,
Yeah.
because that's what's left. And I will, at the same time, fix my fund balance. I'll debit non-spendable fund balance, 45,000. When I debit non-spendable fund balance, now it's showing me 55,000, which it should. Those two amounts have to match, don't they? The inventory and the non-spendable fund balance. And at that point in time, then I will go ahead and do my my adjustment to debit the non-spendable fund balance, credit the unassigned. There's that credit to the unassigned for 45. That brings it back up to 45. There's my debit to the non-spendable. That's what brought it down to 55,000. And then I'll go ahead and do my closing entry. And when I do my closing entry, I will debit the unassigned, credit the expenditure to close the expenditure. And when I debit the unassigned now comes down to 0, doesn't it? And so I end up what? In the same place. I end up in the same place. Where did I put it now? I end up in the same place under both methods. Under both methods, I show what? Inventory 55,000 and non-spendable 55,000. It's just how I got there. Okay? So again, under the consumption method, I'm what? I'm updating the non-spendable and the inventory count as I go, right? As opposed to waiting to the end of the year to catch it up and make the adjustment. Question? Question? Okay. All right. Then let's go ahead back to the quiz. And let's go back and try to find those couple questions we skipped that dealt with inventory. 8 and 9, you say? Okay. 8 and 9. Okay. City uses the purchase method to account for supplies inventory in the general fund. Purchase method is the first one we looked at, right? Okay. So at the end of the year, the amount of supplies on hand is material, and the city wants to report the inventory in its balance sheet. How should the general fund record the inventory? Well, again, when we purchased it, we would have debited expenditure, credited cash, vouchers payable, whatever, for 100,000. We debit expenditure under the purchase method, right? At the end of the year, we do what? For the inventory that was used, 45,000. So we have 55,000 left. So we would debit inventory 55,000, credit non-spendable fund balance 55,000. Is that what we do under the purchase method? So is it true that at the end of the period we would debit supplies inventory and credit the non-spendable fund balance? Is that what we just saw?
Yes.
Got to bring that inventory on the book. Got to set up the non-spendable, right? Okay. Which of the following describes the proper accounting procedures for supplies in the general fund? And we say that supplies may be accounted for as expenditures either when purchased or when consumed. In either case, material amounts of inventory are still shown on the balance sheet, aren't they? So under the purchase method, you can account for them as expenditures as they're consumed, or what? When they're actually under the under the consumption, you'll report them as expenditure when they're consumed. Under the purchase method, you treat them as expenditure when they're purchased. So we do have both of those options, don't we? Either way, we do report inventory on the balance sheet, right? In a non-spendable fund balance. Yes, sir.
You said Gatsby let the companies choose which one they want to use if they're differences, but where does the differences show up if they both end up at the same spot?
The difference is how we report things on the statement of revenues, expenditures, and change in fund balance. Because if you compared the two in that example, under the purchase method, they showed expenditure of $100,000. Under the consumption method, the expenditure was only $45,000, right? Now, when they say they're not going to show material difference, if they use inventory evenly year to year, which you can't really see from a one-year example, but if they use inventory evenly from year to year, then there really shouldn't be much difference between the two methods, right? Because they're going to acquire enough to replenish what they've used, and the amount of expenditure that's shown on the statement of revenues, expenditures, and change in fund balance could pretty much show the same thing, right? As they use inventory, they buy more. As they use it, they buy more. So if they do it that way, then there's really not that much of a difference between the purchase method and consumption method. You can't see it in this example. I would say this is materially different, right? And so you probably would then want to use the consumption method if you had a one-year situation like this. But, you know, I don't want to sit here and go through 3 years to show how they might not be materially different. But if you buy the inventory, you use it up. Think about it. If you bought it and used it all in a year, then there wouldn't be any material difference, right, between the two. So they say, hey, go ahead and just use the purchase method because there's really not going to create any difference if you use the consumption method because you buy inventory, you use it. You buy inventory, you use it. So that's all they're saying. Yeah. Okay. Okay. Let's go ahead then. And let's jump ourselves into, oops, I have to close that. Oh, no, it's over here. Let's jump ourselves into the first practice midterm. And I think for the practice midterms, I have the lectures up there. I'm going to go ahead and record them anyway, so it's kind of all under one file. I don't know. I guess I'll record this. I'll continue recording it. But if you look under practice midterm, you have practice midterm 1. You have chapter 4B quiz and practice midterm 1 lecture. So you may play this old one and hear the same stupid jokes that I told today. Okay, but I'll go ahead and I'll put this new one up, I guess. But in the meantime, it is also there if you want to look at it sooner rather than later. If you don't want to wait for me to take the time to render the video and stick it up there. Okay, okay, but let's go ahead and let's take a look at this first practice midterm 1. Okay, and this first practice midterm 1, guys, is a little heavy in chapter 4A. It's a little heavy in the revenue recognition, so you probably won't have a midterm that goes this much into 4A, into revenue recognition, but you will see probably 3 or 4 questions like this. Okay, all right, so let's just take a look at this one. Number 1. We're into practice midterm mode now, right? Chapter 4A question is what this one is, revenue recognition. So derived tax revenue results for taxes assessed on. We derive it from the underlying transaction. Sales tax is classic example, right? That we use, okay? Regulatory fees such as driver's license is going to fit into the category of imposed. Are what? Infractions of law such as traffic tickets are imposed. Wealth taxes such as property taxes are imposed, right? Only the sales tax would be derived. Any other example of derived? Huh? What? Good. Income tax is derived. The underlying is the earning of income, right? For the taxpayer? Okay, good. Number 2, impose non-exchange, income tax, sales tax, all derived, aren't they? The what? Property taxes we've just said are imposed. Number 3, which of the following comments best describes the recognition standards for derived tax revenue? And derived tax revenue may only be recognized upon satisfaction of purpose restrictions. Sometimes I get students say, well, what's wrong with A? It's complete nonsense is what's wrong with it. It's nonsense. I don't know what else to tell you. Okay? Derived tax revenue are recognized when the underlying transaction takes place, subject to 60-day restrictions associated with modified accrual. Isn't that what we said? Okay, they're recognized when the underlying transaction takes place. That's the full accrual rule. And if we're talking modified accrual, then we track the period, how soon after the balance sheet date they collect it. And in this class, we said we would always use 60 days. Okay. Number 4, property tax revenue levied prior to the satisfaction of time restrictions. If we've met eligibility but not time, we are a deferred inflow. Good. Unearned revenue is what? When we have not met eligibility, right?
Yeah.
If you haven't met eligibility, you are an unearned revenue. You can be called a revenue collected in advance. You don't call it deferred revenue. Do you save the D word for what? Deferred inflow. Number 5, the city of Crossroads installed red light cameras to automate the enforcement of traffic laws with specific attention to fining. Oh. Can you read, John? I thought it said filing. Is that how you spell fining? Individuals who run red lights. You've ever been caught by one of these?
Never.
I did one time because it's not like I intentionally ran the red light, so it's not like you see me go, you know. I was just trying to figure out where I was going, I guess, because I don't even remember running the thing. And they clipped me, they got a picture of me running a red light. So the city would recognize revenue from fines when what? We have a legally enforceable claim, and we have a legally enforceable claim if what? The individual is no longer disputing, or they just go ahead and pay. That's evidence of guilt, right? Okay? And so when fines are no longer disputed, or the appropriate legal authority rules that the fine is valid, there's some sort of due process period they give you, 30 days, whatever, to challenge it. Okay, you ever get a ticket, they'll say you have so many days, 30 days, whatever it is, to challenge this. And if you don't challenge it, you are automatically considered guilty, right? So if that period runs, then they could take the revenue as well. Or if you just pay it, you're not disputing it, you can take the revenue then. Okay? The city of Parker issued traffic citations for vehicles parked in locations with expired meters. Citation charged $50 upon discovery and $25 each hour the vehicle is not moved or the meter is not paid. A citizen received a citation for $100, $50 discovery charge plus 2 hours before the vehicle was moved. The citizen successfully challenged a portion of the citation and paid $50 in July. On July 23rd, how much fine revenue are we going to take for that they what? Paid, because we must have had a legally enforceable claim. That's why they paid. And they won on the other 25 plus 25, the other 100. Number 7, city levies $200,000 of property taxes for its current fiscal year. 1% of the tax levy is expected to be uncollectible. The city collects $170,000 of taxes during the year and another $25,000 during the first 2 months of the following year. What should we take as property tax revenue in the general fund? General fund is going to use modified accrual accounting. We take revenue for the amounts we collect during the year and within 60 days after year end, right? Which is this $170,000 plus the $25,000, so it's $195,000. Using the same facts as the previous question, what happens if we're reporting this in the government-wide level? Government-wide level, then what? We don't worry about collection, right? We don't worry about when we collect it, but we do reduce the revenue by the amount we think we're not going to collect, right? So we would take that full levy of 200,000 times 99%, because when we said 1% is uncollectible. Question? Okay, good. Number 9. City levies 200,000 property tax for the current fiscal year. 1% of the tax is expected to be uncollectible. The city collects 170,000 of its taxes during the year, another 25,000 during the first 2 months of the following year. In addition, the city collects 3,000 of prior year taxes during the first 2 months of the current fiscal year, and another 2,000 during the remainder of the current fiscal year. So that 2,000 that came in from the prior year, but it comes in what? Past 60 days is now revenue of the current year, isn't it?
Yeah.
Flips into being a revenue of the current year. So now we take the amounts from this year, 170 that we collected, the 25 that we collected within 60 days of the current year, and then 2,000 from the previous year because it slipped outside of what? The 60 days of the previous year. So we have to bring that in now. Right? No. 3,000 of the prior year came in during the first 2 months of the current fiscal year. So that's still the prior year's money, right?
Right, so shouldn't it be 198? Oh, okay.
Okay, first of all, let's all agree 170 plus 25 plus 2 is 197, right? Okay. We get why the 170. That was for the current year, collecting the current year. We get the 25, and that was for the current year, but it was collected within 60 days of the current year. The remaining 2,000 was amounts that were collected what? Collected in the current year, attributed to the prior year, but it fell outside of 60 days of the prior year, so it becomes the current year's revenue, right? Okay? Okay? Okay, good. Number 10, if a city receives notification of a grant award and the actual proceeds 60 days prior to the start of the grant period, the entry to record the grant in the special revenue fund is a debit to cash and a credit to what? Deferred inflow, because we received the money before we could begin to use it, right? And we can't take it as a revenue until use may begin. So they kind of messed you up here in that what? They called out that 60 days, trying to get you to think, oh, well, 60 days means we can take it as revenue. If you're getting it 60 days before the period when use may begin, I mean, the 60 days is irrelevant, right? If use may not begin until the next year, it's a deferred inflow, right? And if you're being told that you got the grant, you've met the eligibility, right? So you've met eligibility but not time, right? So they called out 60 days here just to mess you up, to get you start thinking, oh, it's okay because it's 60 days. If you get it 60 days before use may begin, it's a deferred inflow. We count it as revenue if we get it what? 60 days after use may begin, right? Then we can still count it as a revenue in the current year, right? Number 11, the county received $1,500,000 restricted grant from the state government to be used to improve its public safety department's communication systems. The county will not meet all eligibility requirements of the grant until the next fiscal year. If you don't meet eligibility, you are what? You are a liability. You are an unearned revenue. You could be revenue collected in advance. We don't use the D word. We don't call it deferred revenue because we save the D word for what? Deferred inflow. But if you don't meet eligibility, you are a liability, right? Number 12, the city of Ruth has been awarded $1 million federal reimbursement grant to improve bike trails. The city has incurred $418,000 of qualifying expenditures during the year, for which the federal government has reimbursed the city $180,000. How should the city of Ruth recognize the revenue? Well, if they've incurred $418,000 of qualifying expenditures, have they met eligibility? They've met eligibility. Do they call out any time requirement here? Huh? They do not call out any time requirement, so the entire 418 is revenue, isn't it? They would debit expenditure, credit cash, debit the grant receivable, credit revenue. We don't spend any time in deferred inflow status because there is no time requirement on this, right? So it goes straight to revenue. Goes straight to revenue, doesn't it? Okay. So the answer here is what? C. No. 418,000 is the answer. It goes straight to revenue, right? Have we met eligibility? We had to spend the money. It's a reimbursement grant. We met eligibility because we spent the money, didn't we? So we can take it straight to revenue, don't we? We debit grant receivable credit to revenue. You take revenue when you meet eligibility and time. Have they called out a time requirement? The only eligibility requirement is that we had to spend the money. Did we spend the money? We spent 418, so the entire amount is revenue, isn't it? Entire amount is revenue? Yeah.
When you receive the money, would you just debit cash and then credit like an AR account? Or?
Yeah, credit grants receivable. Do we spend money in this example? So we would have debited expenditure. What is it? 418,000? Credited cash, right? We spent that money, didn't we? Did the government, did the higher level government, I don't know, was it the federal government, whoever, tell us that they would reimburse us? Did they tell us they would reimburse us? So are we eligible for this? Are we eligible for this? Do you see any time requirements? I do not, so it's revenue, isn't it? I've met eligibility, there are no time requirements, it's revenue. So I will debit grant receivable 418,000 and I will credit the revenue 418,000. It goes straight to revenue now because I've met the eligibility requirements, haven't I? I debit grant receivable, I credit revenue for 418. What do I do when they pay me?
Debit cash, credit grant receivable.
Good. Debit cash for 418. Credit the grant receivable. I'm going to abbreviate GR. 418,000. Because now I got paid. So what's the answer here?
I see 418,000 is the answer.
Good. 418,000 is the answer, right? So why did I put a green on D? Because that's what the textbook had said was the answer. And when I wrote the textbook, remember the people that acknowledged me in the front of the book? So then I got into a dialogue with the author, and I wrote the author, and I said, hey, this question in the test bank, I don't understand. Why would it be 180,000? We've met eligibility requirements. It's revenue. He says, you're right, John. I didn't write that question. Okay, well, but your name is on the front of the book that it contains this question. Not using that book anymore. That's the end of them. Okay. Actually, I wouldn't get rid of them because of this typo. What I got rid of them for is, remember they didn't change the budgetary control thing in the back? They didn't change it in the back, and when I asked them to change that, they refused because now they had printed the book, and it was too late, and they didn't bother to go through the whole book and change all of them, so that's why I got rid of the book, because now halfway through the book, I got to start explaining to my students why it's the other way in the back of the book. That's when I got rid of it. He says, well, my students don't seem to mind the difference. In other words, your students don't mind when you teach them wrong. Is that what you're telling me? Okay. Number 13, if a city receives notification of a grant award and the actual proceeds 60 days prior to the start of the grant period, didn't we have this question already? Debit cash, credit deferred inflow. You get it before the grant period begins, that's a deferred inflow, right? Because that's a time requirement. We received notification of grant award, and they sent us the cash. Hello, are we eligible? We're eligible. We got the grant award. We can't credit revenue yet, though, because the grant period hasn't begun. Which of the following has the highest level of authority? I mean, this could be a question. By the way, if you're wondering what some of this is, PM2, question 22, that's practice midterm 2. Oh, yeah, that's all right that it's chapter 1, because this is now practice midterm, right? This is potentially all the chapters, 1 through 4 now. So this is more of a chapter 1 question. And practice midterm 2 and question 22, same as question practice midterm 3, question 25. And I started doing that because I had one class that said, you asked us completely different questions on the exam. So I went through question by question and pointed out where they were the same questions as the practice midterms. So that's all that means. Okay, so which of the following has the highest level of authority for a government in the governmental gap hierarchy? Is Gatsby's your daddy, right? Okay. In which of the following financial statements would a government not report depreciation expense? We don't report fixed assets. We don't report depreciation in our governmental funds, right? So this is going back to chapter 1 now. The availability criteria for recognizing revenue applies to all the following funds except it has to be what? Measurable and available is what we use in the for our governmental funds, and we've defined available as being what? Collected within 60 days of the balance sheet date, meaning it's available enough to pay expenditures of the current period. You know, we're assuming that your bills are going to be coming due in about 60 days there, right? If your bills come due in 30 days, then maybe 30 days is the period that you use. If your bills don't come due until 180 days, maybe 180 days is what you use. So you'd have to look at what's going on with that particular fund to see when their bills are coming due to figure out the time period. But in this class, we'll always use what? 60 days? Okay, so you come over and what? The availability criterion is for our governmental funds. Is the capital project fund a governmental fund? Is the debt service fund a governmental fund? Yes, it is. Is the special revenue fund a governmental fund? Yes, it is. So it's what? Internal service fund uses full accrual. Then we're only worried about what? And if it's an internal service fund, it's probably an exchange transaction, so they've provided the service that generates the earning of that revenue, right? Which of the following fund may government report capital assets? Capital project fund, governmental fund, general fund, governmental fund, special revenue fund, governmental fund. The only one up here that uses full accrual accounting is the enterprise fund, right? The basic financial statements include all the following. That's that graphic that I showed you that I made a big deal out of. We had the MD&A. We had that was required supplemental information. We had the basic financial statements, which included the government-wide statements, the fund financial statements, and the notes there too. We had required supplemental information other than the MD&A, right? In the bottom box. So what happens? The basic financial statements are the government-wide, the funds, the notes there too. Where do combining statements fit in that whole thing that I just told you? Or are combining statements the MD&A? Are they required supplemental information other than MD&A? No, the combining statements were what? Optional, weren't they? So they were completely off the chart? Okay. Okay, so you're starting to see something here, which is what? You got some work ahead of you, right? I mean, all of this stuff is not too difficult, but it's enough that you're going to have to go back and revisit some of the slides that cover some of these things. You're going to have to go back and revisit the lectures for certain areas. If you come to this practice midterm question, you're like, what the hell? Then you're going to have to go back to what? Chapter 2 and say, where did we talk about combine? Oh, there it is. Oh, it says optional. If it's optional, it's not required, right? Okay. Okay, good. Okay, GAAP requirements for external financial reporting. Is the annual report required?
No.
It is not. It is an optional document, right? Okay. And you look, the transmittal letter and the statistical section are part of that annual report, aren't they?
Yes.
So the only one that really fits that's required is the note disclosure. That's part of the basic financial statements, right? The MD&A is required. The basic financial statements, which are the government-wide statements, the fund financial statements, and notes there too is required. The required supplemental information other than MD&A, hello, is required, right? Not these other things that are part of the comprehensive annual financial report. The comprehensive annual financial report is not required, and the things that go along with it are not required. Why do governments prepare it? They want the award. They want the GFOA award, don't they? Okay, when you become the CFO of the city of San Jose, it'll probably be written into your executive contract that you will continue to maintain a level of reporting that's consistent with that award, right? Basic financial statements exclude, well, do they include the government-wide? Do they include the fund statements? Do they include the notes there too? They do not include the MD&A. Now, MD&A is required, but it's not part of the basic financial statements, right? Government-wide financial statements include. Did I say that you have to know the name of all the statements? Did I say that? Yes, I did. You have to know the names of all the statements. When we're talking about government-wide, the balance sheet is the statement of net position. The income statement is the statement of activities. If we're talking about the what? We're talking about the governmental fund financial statements. The balance sheet is called the balance sheet. The income statement is called the statement of revenues, expenditures, and changes in fund balance, right?
Net position.
No, fund balance. Fund balance for the governmental fund. Statement of revenues, expenditures, and changes in fund balance. If we're talking about our proprietary funds, the balance sheet is the statement of net position, and the income statement is called the statement of revenues, expenditures, and changes in fund net position. Okay? And then if we're talking about what? The proprietary funds, do they prepare a third statement? They're the only category of funds that prepare a third statement. They prepare a statement of cash flows, don't they?
Yes.
And then if we're talking about the fiduciary funds, we're back to just the two. The balance sheet is called the statement of fiduciary net position, and the income statement is called the statement of changes in fiduciary net position. Do you have to know the names of all the statements? Don't worry about this question. There must be something I don't like about it. Number 23, a statement of revenues, expenditures, and changes in fund balance is required for the governmental fund, right?
No.
Yes.
Oh, yeah.
Don't tell me no. Okay.
Forgot that special revenue fund is a part of it.
Special revenue fund is a governmental fund, right? Yes. Okay. These other are not governmental funds, therefore they're not the right answer, right? Which of the following would not be considered a fund financial statement? How about the balance sheet? Balance sheet is the name of the balance sheet for the governmental funds, right? How about statement of cash flows? Yes, my proprietary funds prepare a statement of cash flows, don't they? Internal Service Fund, Enterprise Fund. So it's still a fund even though it's a proprietary fund, right? How about my statement of changes in fiduciary net position? That is prepared by my fiduciary funds. The only one that is not a fund is the government-wide statements, which has a statement of net position and a statement of activities. Do you have to know the names of the statements?
Yes.
Do you see how it can get very funky if you don't know the names of the statements? What did the person say? You have to know your stuff? Okay? A statement of cash flows is required for who? The proprietary funds only, right? Enterprise fund, internal service fund. Guys, agency fund is now called the custodial fund. Remember, we have the custodial fund. So if you're saying what's an agency fund, it's now called custodial fund. The old name was agency fund. So I could still put agency fund in a question, and you would still have to know not to include it because only what? Only the proprietary funds prepare a statement of cash flows, right? So I could put some funky, bogus name of a fund there. I could say the Caterpillar Fund, right? And the answer would be no, it's the Enterprise Fund. Well, yeah, you're right, because I started thinking Caterpillar Enterprise. That's a good point. Might be confusing if I call it Caterpillar, huh? I could call it the Projector Fund. How about that? Okay. Okay, good. A city receives a donation from a citizen who specifies that the principal must be invested and the earnings must be used to support the city-owned recreational facility. The principal of this gift should be accounted for in the permanent fund. And remember, I warn you, if I tell you a dumb story, pay attention. We had the what? The story of Miss Hayward that gave the city of Hayward some money and then said, hey, hold the principal forever. You can use the interest to run the park. That was an example of a permanent fund. Number 27, the portion of special assessment debt maturing in 5 years. Stop. Even if you don't know what special assessment debt is 5 years considered a long-term liability? Usually it's a year or less that makes it a current, right? So if it's 5 years, it must be long-term, right? Where do we report long-term liabilities? At the government-wide level we report it, or in our proprietary, our fiduciary funds, right? Our governmental funds do not report long-term items, neither assets nor liabilities, right? So when you start looking here, is the general fund a governmental fund? Is the general fund a governmental fund? Is the capital project fund a governmental fund? Is this question screwed up a little bit? Yes, it is, because it's calling out agency fund, and we don't know enough about what should be called custodial funds now for me to legitimately ask you that question on the first midterm. So I probably should not have asked this on the first midterm. I could ask it to you later when we get to custodial funds and understand a little bit more about what they do. And I'd have to, of course, appropriately call it custodial fund, not agency fund. So this question wouldn't be good for your first midterm. But you should know that what? Long-term debt shows up where? Government-wide only, right? Of the not the governmental funds. Let's put it that way. Not the governmental funds, which would make A and D a wrong answer. So I could change this to special revenue fund. I could give you the same question and change this to what? Special revenue fund. Now this question makes sense, doesn't it? Number 28. A city government would report each of the following categories in the government-wide statement of net position except what? Governmental activities has what? General fund, special revenue fund, debt service fund, capital project fund, permanent fund, and? No. Governmental activities, we got 2 columns on the statement of net position, don't we? Governmental activities and business activities. What goes into governmental activities? Grasp plus the internal service fund, right? Okay, is what was reported there. Okay. Business type activities are what? No, business type activities are the enterprise funds. Where's KIP? KIP is not reported at the government-wide level, right? We don't report at the government-wide level, the fiduciary funds? Okay, component units, yeah. Remember, we have component units, our children. Report the component units in a column using discrete presentation. 29. For governmental fund types, which item is considered the primary measurement focus? It is modified accrual accounting, current financial resources measurement focus, and what? Fiscal accountability, right? Right? Remember the slide with all the stars all over it? That showed all the funds and show how they rolled up under governmental activities, business type activities? Which of the following is the measurement focus for the government-wide and basis of accounting? Economic resources and what? Full accrual basis of accounting. How about accountability? Good. Operational accountability, right? That one slide with all the stars all over it. Okay? All right. This is what your midterm is going to look like, guys. It's going to be something like that. Although I take that back because I didn't show you any of the 4B type questions because we just looked at some. Okay, but if you take the 4B practice midterm that we just went through or quiz that we just went through plus this practice midterm, that's pretty much your exam. Okay, next week we're going to go through the other two practice midterms. So what I want you to do is take a look at those two files so that we can sit there and quickly have any questions answered, quickly go through those questions in our final prep before the midterm. Okay? All right, guys. Have a good rest of the evening. I will see you next time. No sign-in sheet.